Welcome back. Almost all the banking results are out. NBFC results are out. And one key takeaway from the NBFC and banking results is that it was not as bad as the market feared. The expectation of the 100 basis point repo cut on margins was a big fear in the market. But many of the banks, large banks, reported higher margins than in Q1. To analyze the set of results and to check out which are still good buys at current prices, Suresh Ganapathy, the Managing Director and Head of Financial Services Research at Macquarie Capital, joins us. Good morning, Suresh. Thank you very much indeed for joining us. Let me start with the ones who announced numbers last, that is, Paytm and State Bank. First, with State Bank, it looked like it was a beat all across, but you're not impressed. I think you still have an underperform on the stock?
Yeah, so look, it was, of course, a pretty good set of numbers. More importantly, as you rightly summarized at the start of this call, that all banks seem to have done much better with respect to margins, and especially on the liability management side, where the cost of funds have, of course, fallen much sharper than expected, and therefore the overall eventual outcome on margins have been way better, and that's what has happened with SBI. The only point here is that SBI had an ROA of about 1.15% odd or so. A large part of it in the first half has got to do with a lot of treasury profits, Latha, which happened in the first half, right? First quarter was bond gains, and this quarter was Yes Bank stake sale. Now, these things are not recurring. So in the sense that you are more like a 1% ROA, and with some kind of an ECL related credit cost coming through your P&L, because currently they don't make really much amount of provisions on SMA 012 assets, you will of course see maybe the ROA is dipping below a percentage point or so in another 12 months' time. That's how we are looking at it, because some of these things are not sustainable.
No, fair point. But there was BOB announcing that there will be a 22 to 25 basis point impact on the credit cost. You think it has colored investor impact on all public sector banks?
I mean, look, see, not all of them have reported the ECL impact, but whoever has reported the rough impact on a transition basis on the net worth is anywhere between 7 to 10%, Latha. So you can go with that kind of a ballpark number. Some banks could be at the lower end of that number. But the sustainable increase in credit costs, because remember that the SMA 1 or 2, the RBI is saying you need to provide 5 percentage points, whereas currently these guys provide only 40 basis points, right? So it's a substantial quantum jump. Now, of course, the SBI management itself is saying that they're representing to the RBI that some of these floor rates recommended are a little bit higher at this point in time. But if I were to literally go by what has been prescribed very clearly, the 20-25 basis points given by BOB is something that will be applicable across the board. So the 20-25 basis points on credit cost is more like a 10-15 basis points on ROA, right? And about 200 basis points impact on ROE. That's something I don't think the market is fully factoring in, which is what I think we need to be really watchful about.
But this 2025 goes over several years, does it? I didn't understand what Mr. Chand was trying to say.
No, that
is it only in the starting year, or will it be in subsequent years as well?
So there is two impact, Latha, here, right? One is on
the net worth impact. That's different.
That is on the existing portfolio. Okay. Now the other impact comes when you do business in the normal course. In the normal course, you'll always have an SMA 012 assets.
Okay.
There currently you're only providing 40 basis points. Now you have to take it up to 500 basis points. So this is 20-25 basis points annual increase, sustainable increase, which will be there for every year as long as you keep doing business.
Fair enough. Yeah. So that's that cost will come. Okay, right. Now Paytm, again, I thought the numbers were quite good, but you have an underperform again, probably because it's already a costly stock. But tell us your thesis.
Yeah, so of course on the valuation side, I mean, some of these new age companies are always going to be a bit tricky to value, and we not even on PB Fintech for that matter, we have a neutral rating. More from a valuation perspective, look, if you look at Paytm's numbers per se, the revenue line item was in line with expectations, right? So where they have done a really good job is on the cost control. They have been able to demonstrate good amount of operating leverage in the business. So maybe they're using AI. They have also, of course, cut their workforce over the course of last 12 to 18 months. So you can clearly see much better outcomes on the operating cost front, and therefore the profitability is improving, and they are generating accounting PAT, which could be sustained as long as they keep a very tight leash on their cost. Yeah, sorry.
Okay. Yeah, I can get absorbed in the HDFC versus ICICI debate, so I'll see if I have time for it. You have some outstanding comments to make on City Union Bank on the bank side and AB Capital on the NBFC side. Tell us why you like City Union Bank so much.
Yeah, look, I think you have to understand that, in today's times when there is a lot of story being spun around about some of these older private sector banks, whether they can generate 1.5% ROA or not, and what could be the path towards it. I won't like to take any of those names, but the expectations are running very high. Here is a bank which is already generating and delivering 1.5% ROA, which is a great outcome. Sustainably over the course of last several years, I would say, except during the COVID years, perhaps, and period post that. And also at the same time, growth is back, right? So they have grown their balance sheet, I know of a small base, but one of the bigger concerns was whether growth can come back for them. So here is a bank which is growing well. ROA profitability is very good, and is trading at a pretty cheap valuation. In the peak, City Union used to trade even at 2 times price to book. So that's the kind of opportunity and upside that you still see in the name, which is already delivering that golden 1.5% ROA for the mid-sized ones. As far as AB Capital is concerned, look, I'm pretty much comparing with some of the new age companies, right, or new listings, sorry, for that matter. Look at the HDBs and the Tata Capitals of the world, which are currently listed, and they all trade at 2.5 times forward price to book. Here is a company which is trading at 1.5 times, right, and having an ROA which is similar to them and growth profile which is better than them or maybe equal to them, right? And that's a glaring gap, and that's the reason why it becomes a clear pick for us at this point in time. And numbers have been good so far. Yeah.
Okay. Is that also one of your super six or something like that?
Yes, that's right.
So it's in your up list.
So it's across all the sectors where we identify some of these mid cap guys where there is a longer term potential, and in the NBFC or in the overall, for that matter, in the financial services space, AB cap falls under that.
Okay. If you have to choose between HDFC Bank and ICICI Bank?
Look, I mean, both are good companies, good stocks. Valuations are still reasonable over the longer run. It really depends upon the time frame and the horizon that one has, right, from an investor standpoint, right? So if you're looking at the next 6 to 12 months, clearly you're going to see HDFC Bank getting its mojo back when it comes to its growth, and will be the sector leader in terms of its growth, in my opinion. And that is the reason why, as the growth convergence happen, one can argue that HDFC Bank can converge to ICICI. And the second thing, as we all know, that Mr. Bakshi is slated to retire on October 2026. And there are uncertainties surrounding his tenure. Right? Typically, stocks don't perform that well whenever there is a CEO related uncertainty. For all that, he could get another 3-year extension and things should be fine. But currently we're going through in that uncertain phase, which is what we need to be a bit careful about.
Well, actually his term ends and he's very much eligible, way below the retirement age. So I am still not believing this rumor. It was only a rumor which ICICI has scotched in no uncertain terms. So we will leave it at that. Let's see what happens in 2026. Just finally, Suresh, would you say in your overall, I mean, this is a head of research question. Where does finance figure in the bouquet of sectors that Macquarie recommends? Is it up there?
Yeah, pretty much. See, if you look at it in this way, Latha, we always start the year with a 15-16% broader market earnings growth, and eventually, unfortunately, the earnings keep getting cut for the overall market. But even if I were to really look at next year, maybe the overall market can grow potential to 12, 13, 14%. But financials, very clearly, there is a visibility of a 20% earnings growth. So it will outperform the broader market by a good amount of margin. That is only because the first half base this year has been very tough. You've gone through a margin compression. You have gone through, though banks have done a better job relative to expectations, but still YOY the margins have gone down for SBI, for everybody else in the system, right? And you've also seen credit costs being elevated in certain cases, like for Kotak and Axis. If you look at next year first half, and of course probably second half, you are going to see margins being relatively positive. That means in an upward move, and credit costs being down. And loan growth should be about 15-16% or 14-15% for the private. So clearly you're looking at a 20% kind of an earnings growth for the broader financial space, outperforming the broader market.
Fair point. So while the rest of the market may grow at probably 13% earnings growth, banks could report 20%. That's the big takeaway from Suresh Ganapathy. And very importantly, old private sector banks, the story is turning. This is a story for another day. First it was Federal, then now RBL, now CSB turned City Union. That's a story to be narrated on another day. Thank you very much, Suresh, for joining us. We have to wrap up on Bazaar. Chartbusters coming.